Good day and welcome to the DoubleLine International Fixed Income Funds webcast. Today's conference is being recorded. At this time, I'd like to turn the conference over to Mr. Colin Callahan, Product Specialist. Please go ahead, sir.
Good afternoon and welcome to the DoubleLine International Fixed Income webcast, hosted by portfolio managers Su Fei Koo and Valerie Ho. Before we dive in, you can find our upcoming webcast on the screen, including the Income Fund webcast on May 16th, hosted by portfolio managers Ken Shinoda and Morris Chen, and on May 23rd, the Floating Rate webcast, hosted by portfolio managers Robert Cohen and Phil Kenny, covering the DoubleLine Floating Rate Fund. To register for these webcasts and others, please visit doubleline.com. Next on the screen, you can find DoubleLine's media thought leadership, including our video series Channel 11, hosted by portfolio manager Ken Shinoda, and our two podcasts, The Sherman Show, hosted by Deputy CIO Jeffrey Sherman and portfolio manager Sam Lau, and the Monday Morning Minutes podcast, hosted by portfolio managers Sam Lau and Jeffrey Mayberry. And at the bottom of the screen, PS Perspectives, hosted by DoubleLine's product specialist team. DoubleLine podcasts are available on a wide array of platforms, including Spotify, Apple, and Google Podcasts, among others, while our video series can be found on the DoubleLine Capital YouTube page. Today's webcast will cover four funds: the DoubleLine Emerging Markets Fixed Income Fund, the DoubleLine Low Duration Emerging Markets Fixed Income Fund, and the DoubleLine Global Bond Fund, and the DoubleLine Emerging Markets Local Currency Bond Fund. All are offered with two share classes, a retail class, N share, and an institutional class, I share. Minimum investment amounts and expense ratio details are listed on the page for both share classes. And quickly on standardized performance, the DoubleLine Emerging Markets Fixed Income Fund year-to-date through the end of March has returned 1.59% on its I share. The DoubleLine Low Duration Emerging Markets Fixed Income Fund year-to-date through the end of March has returned 1.15% on its I share. The DoubleLine Global Bond Fund year-to-date through the end of March has returned 2.55% on its I share. And lastly, the DoubleLine Emerging Markets Local Currency Bond Fund year-to-date through the end of March has returned 4.52% on its I share. With that, let me turn the webcast over to portfolio managers Su Fei Koo and Valerie Ho.
Thank you, Colin. So thank you for everyone for joining today. The title of today's webcast is Embracing Challenges, with the key focus on emerging markets. So looking back in 2022, that was certainly a year of unpredictable shocks to the global economy. We saw the Russian invasion of Ukraine, which led to commodity price spikes and severe food shortages. We also saw China's pandemic lockdown and its draconian zero-COVID policy, while at the same time, we saw the rest of the global economy reopening, which unleashed pent-up demand. We saw accelerating inflation and global central banks embarking on an aggressive tightening cycle, creating a particularly challenging environment for emerging markets. Looking forward for this year, we expect it to be an equally challenging environment. The IMF, hang on here to get to my slides. The IMF released its semi-annual World Economic Outlook in April, and the release was aptly titled A Rocky Recovery, describing a very uncertain outlook. They described the economy as entering a perilous phase in which economic growth remains low by historical standards, financial risks which have risen, and inflation which has not yet decisively turned the corner. And while they stressed that financial stresses are contained, they warn that risks are skewed to the downside. Importantly, one of the quotes I wanted to highlight is policymakers may face difficult trade-offs to bring sticky inflation down and maintain growth while also preserving financial stability. We here at DoubleLine agree with the IMF. We think that central banks currently are in a rock and a hard place, balancing the trade-offs of monetary policy. However, we do see divergences between economic and monetary cycles, giving emerging markets breathing room to weather some of this market turbulence. The IMF is forecasting a slowdown in the global economy. However, this slowdown is largely led by advanced economy, expected to fall nearly in half to 1.3% versus 2.7% in 2022. Conversely, in emerging markets, 2023 growth is expected to be relatively flat relative to the prior year. Now, while growth is expected to accelerate, surprisingly, data since the fourth quarter has been coming in stronger than expected. And despite the recent financial stability concerns, growth projections by the IMF have been revised up relative to the prior forecast, which was published last fall. The stronger data can be best reflected in the improving global PMI data set, particularly on the PMI services. This has been a common theme across all economies where growth has been led by the service sector, reflecting the transition from consumption-led growth to service-led growth. And as we'll see, this has created many uncertainties for central bank policies. Now, despite the better than expected data, this hasn't been enough to change the recession probability outlook, where recession probabilities are concentrated highest for the advanced economies. We thought this was an interesting look on the recession probabilities over the next 12 months, focusing on key markets, the US, the European Union, and China. No surprise, China recession probabilities remain low. While when we look at Europe, which is the purple line on this chart, we saw near certain European recession fears have largely abated, falling with this recession probabilities falling largely in half. At the same time, U.S. recession fears, which is within the blue line on this chart, is seen as climbing up to 65% probability of a recession, but we stress that the timing and magnitude remain highly uncertain. So let's dive into the U.S. data. Here we have the U.S. PMI chart. This chart has a very different look from the global PMI chart. Manufacturing PMI is clearly weak, falling well below 50. And while the services PMI is at still expansionary levels, the trend is clearly lower. We see that the fall in sentiment in the U.S. Has followed the collapse of the Silicon Valley Bank episode last March. While we think that lender last resort policies have backstopped the regional banks and has really calmed fears for a banking crisis, we look to see what the macro implications could be from the banking fallout. Yesterday, we got First Republic data with deposits outflow bigger than expected. I think this isn't entirely surprisingly, as we expected to see a rotation of deposits from the regional banks to the G-SIBs. The biggest macro implication we think is likely to be the tightening of bank lending standards, with the biggest impact on small and mid-sized companies. However, we have yet to see a contraction in the credit lending in the credit lending data really come out yet. So as we wait to confirm the slowing credit growth, we look at sentiment data to view how borrowers are looking at credit availability. Here we have the New York Fed survey data reflecting the perception of credit availability, and it's showing that credit availability has deteriorated. So the blue line and the yellow line collectively show the number of respondents who said it was either much harder or somewhat harder to obtain credit relative to a year ago. This cohort rose to 58% of all respondents, an all-time high for the index. However, we think questions remain of how quickly tighter financial conditions will trickle down through to slower growth, and lingering financial stability concerns will complicate the Fed job, which is trying to calibrate monetary policy to quell inflation while also monitor financial stability risks. As we move to Europe, we can see a very different picture in the PMI data compared to the US, reflecting upside growth in Europe. Again, we see services leading the way, with services PMI pointing to expansionary territory. Now, growth in Europe really stabilized after the energy crisis was averted last winter. And we thought that these two charts did a pretty good job in summarizing the energy crisis that unfolded. So last year, of course, we had the invasion of Ukraine by Russia. multilateral sanctions placed on Russia, and then Russia subsequently shutting off pipeline gas to Europe. This led European leaders to scramble to refill their gas storages ahead of winter, resulting in gas prices spiking at the end of last summer and rising recession risk in Europe. Fortunately for Europe, it was a mild winter. Policy was able to lower gas demand and push to substitute gas for other fuels, allowing Europe to refill its storage capacity. Thus, we saw an easing of the crisis and gas prices falling 75% from its peak. We stressed, though, that while concerns of supply shortages have faded, Europe still faces the risk coming into this winter, particularly if demand picks up or if we see an unseasonably cold winter. As we move to China, we see a positive picture in the PMI data. This is largely reflecting the upside growth in China given the end of its zero COVID policy. Manufacturing PMI remains at expansionary territory, while services PMI accelerating upwards at 57.8. Since the end of China's zero COVID policy, Chinese authorities have responded with a variety of measures to support growth, whether that be from easing of monetary policy, tax relief for firms, support to the real estate sector, and vaccinations for the elderly. As a result, mobility, you can see, has normalized in China, and high-frequency indicators on measures such as retail sales and travel bookings have started to pick up. We've also seen hard data come through with first quarter GDP rising 4.5% year over year, better than expectations, and strong export data in March rising 50% on year over year terms. Thus, we see China's economy entering the second quarter with significant momentum. Here's another look at support to China's economy, which has been supported by the credit impulse. This is a chart on the 12-month change in new lending increments over China's GDP. And you see that credit lending is picking up, which we believe is going to be a further support and stimulus to the economy. Why does it matter? Of course, China continues to increase its share in terms of its contribution to world GDP, as well as its share in world exports. So the reopening in China, we think, is likely to generate positive spillovers, particularly for countries and emerging market countries which have strong trade linkages to China. And we can see this China growth story being reflected in emerging markets composite and manufacturing and services PMI. Again, services PMI very strong, while manufacturing PMI is also above 50. Now, the growth outlook is differentiated across regions. We see improving growth from 2022 to 2023 in emerging Asia and emerging Europe, largely reflecting the positive growth momentum in China and core Europe growth stabilizing, while we see declining growth over year over year, declining growth relative, to 2022 in Latin America, the Middle East, and Sub-Saharan Africa. One potential upside to the EM growth story, we think, is the commodity cycle. Here we can see commodities both on the metals and energy side look relatively weak, though perhaps have bottomed. But given the tight commodity markets, we think that any increased in demand, whether that comes from the China reopening story, better than expected growth in Europe, U.S. averting a recession, we think this could be a tailwind for demand, propping up commodity prices, which would also be a tailwind for EM commodity exporters. This positive growth story has resulted in the widening of the EM-DM growth differential, a ratio that has been a strong predictor in the past of EM performance. Now, while central banks may be welcoming decelerating growth, inflation dynamics remain worrisome. With the exception of China, we see the world dealing with an inflation problem since 2022, and as supply chain disruptions have eased and base effects are rolling off, we do see easing of inflation pressures. Unfortunately, for many central banks, inflation remains far above target. Part of the story we all know has been the shift from goods to services as a major contributor to inflation. This has led to less pronounced deceleration in some of the core inflation measures. And with growth yet to decidedly turn corner, services remaining strong, and tight labor markets, particularly in developed markets. This has created a lot of uncertainty if central banks have done enough to bring inflation down to target on a sustainable basis. So what have central banks done so far? Has it been enough? And which central banks can begin to ease policy to begin to support growth? Here we have a look of the cumulative average hikes across regions, and we can see that many EM central banks and many within the regions have started the hiking cycle earlier and have been much more aggressive. Particularly in Latin America, LATAM central banks have hiked on average a cumulative 955 basis points and is currently the only region to have brought the policy rate above the current rate of inflation. The outlook for the other regions within the central banks is mixed depending on our outlook for inflation. So here we have the ex-ante real policy rate. This is the current policy rate less inflation forecasted 12 months advance. Here we're using JP Morgan inflation forecast. You can see countries which have hiked more expeditiously have higher ex-ante real rates and likely more room to cut assuming the disinflation cycle materializes. We can see high real rates in Latin America, but also now high real rates in emerging Europe as well. In the advanced economies, you see relatively high real rates in the US and Canada, modestly positive rates in the European Union, and Japan remains the noticeable outlier given its ultra-easy monetary policy and yield curve control, which, according to the incoming governor, Ueda, is unlikely to change, at least at this upcoming Bank of Japan meeting. Now, different stages of the monetary cycle has led to divergences in expectations for central bank policy. And monetary policy divergences has been one of the leading drivers of FX and rate performance. Here in yellow, you can see the expected changes in the central bank rate by year end, which is implied by market pricing. US and Canada are both expected to see cuts by year end. Conversely, we can see the ECB, the Bank of England, and central banks in Australia and New Zealand expected to have further hikes into the end of the year. Here's a look of the effective Fed funds rate versus the Fed funds futures implied by the market. You can see that the Fed dots are not forecasting any cuts over the remainder of the year, much more hawkish compared to the market implied pricing, which is confirming one additional hike next week in May, but then 50 basis points as I walked into the meeting into this call today of cuts by year end. Now the dollar has been sensitive to the repricing of Fed monetary policy, so it's possible to see a near-term move higher in the dollar if we see the market begin to reprice to Fed expectations, thereby removing expectations for rate cuts from this year. However, we do view a backup in the dollar as a possible entry point to add to our short dollar position. Here we have the ECB market implied policy rates. We can see the ECB has been fairly hawkish in its rhetoric. The terminal rate has shifted above 3.7%. This implies an additional 75 basis points of hike into year end, no cuts into 2023. And given the incrementally more hawkish ECB relative to the Fed, this has led to euro appreciation, with the euro touching 110 just today. This next section, we will review FX rates and market index performance. Here's a look at the dollar as measured by the DXY index. We can see that the dollar peaked in 2022 before declining in the fourth quarter. For the start of the year of 2023, the Dixie's really been choppy between 101.5 to 10, choppy in a range of 101.5 to 105 for this year. Conversely, EM currency performance has been relatively resilient despite all the financial stability risks that we've seen and all the recession warnings in the US. We think the narrative peak Fed fund rates and peak inflation is supportive in the context of the EM carry trade. Here's a look at FX spot performance. The best currencies relative to the dollar has been the Hungarian forint, the Mex peso, Chilean peso, and Colombian peso. These are all countries with high real rates. We thought it was also important to review the dollar SMAL framework. Within this framework, the dollar tends to appreciate during periods of risk aversion or global recession, and also in periods of U.S. exceptionalism. Given the resiliency in EMFX this year, it's been much more of a dollar smirk story as opposed to a dollar smile story. Part of that has been the fading U.S. exceptionalism, given the stronger growth we've seen in Europe and China, and also that we largely think that a banking crisis has been avoided, which has allowed the market to move away from a full risk aversion mentality. Over the medium term, our outlook is to see dollar downside. However, we do look at the risk to this view, which could lead to a dollar higher. That could be the timing and severity of a U.S. recession, certainly heightened geopolitical tensions, perhaps between U.S. and China, renewed banking concerns, and also the brinksmanship upon as we get closer to the X date for the U.S. debt ceiling. And then one last chart, which is supportive for EMFX performance. Here we have the EM-DM growth differential, and this tends to lead EMFX higher when the ratio favors EM growth. So if we see the growth forecast materialize as expected, within the framework of the IMF, we could see EMFX do well for the remainder of this year. Here's a look at global yields. We all know that yields rose sharply over 2022, given the inflation concerns and central bank hikes. We saw the 10-year U.S. Treasury peak at 4.25 in the fall, and yields rally into the end of the year and over 2023. Yields are certainly off their high on slowing growth and sort of been choppy over this year as the inflation debate continues. Here we have the year-to-date look in the change in global bond yields. The top panel is the 2-year bond yield, the bottom panel being the 10-year bond yield. We can see the broad rally across the U.S. Treasuries in the 2-year and 10-year following the U.S. banking concerns. It's been more mixed performance in the European government bonds. Front-end rates in EGBs have pushed upwards on higher inflation and inflation concerns and a more hawkish ECB, while yields broadly are lower in emerging markets with expectations for emerging market central banks to begin cutting, given the fact that they were earlier in the hiking cycle. We thought this chart was interesting. JP Morgan did a look back at the change in EM local 10-year rates over a 6-month period following the peak in 10-year U.S. Treasury yields. And they found that EM rates tend to rally across the board following the peak of a Fed tightening cycle, which can have meaningful outperformance during this period. We agree, though selectively, many local curves we see right now are inverted with front-end rates higher than back-end rates. So with inverted curves and a risk of a global recession, it keeps us selective in EM duration, as the long-end rate could sell off during a recession due to increased risk premium, while the front-end part of the rate curve could rally. And in this final section here, we just have EM and global bond index performance. This is the FTSE World Government Bond Index. This is the Developed Market Government Bond Index. We can see that 2022, which is the red line, had its worst year in history. It fell 18% last year. We're in recovery mode this year. Year to date, The FTSE WIGBY is up 3.3% year to date. This is a look at the JP Morgan TBI EM Global Diversified, the EM Local Currency Index. Again, a very tough year last year for the index, down nearly 12%, but a strong recovery to start for this year, up nearly 5.6% year to date. And the last index, here we have the the JP Morgan MB Global Diversified. This is the dollar EM Sovereign Index. Again, the worst year on record over 2022, down nearly 18% for last year. This year, we see the index up 1.5%. A lot of it being driven by the Treasury rally. And the last section I wanted to go over our country view. So a lot of EM has been driven by the macro environment, but there are idiosyncratic stories that we think are worth highlighting. So what are we watching and why does it matter? First, we're watching the heavy election calendar. We see a heavy election period for both developed and emerging markets over 2023 and 2024. Highlighting two elections where we see a pretty binary outcome depending on the results are in Turkey and Argentina. Argentina, we expect to see a regime shift to the opposition. Polls in Turkey for this upcoming presidential and parliamentary election are much closer. But if we do see a regime shift in both, we could see some positive momentum as more orthodox, reform-minded politicians come into power, though I think the initial adjustment to undo some of the more distortionary policies of his predecessors could be a volatile period for those markets. In 2024, we look to elections in the U.S., European Parliament, and Taiwan. We think that these elections will be key, particularly given the geopolitical tensions that have been simmering over the last couple of years. We also will get elections in South Africa, Egypt, Mexico, India, Indonesia, and Ukraine. And we could have potential elections in Peru and Ecuador. Certainly that depends on the outlook for these countries' very unpopular presidents who have repeated calls to step down. They could call new elections, or they could also suffer the fate of impeachment. In Latin America, on the country outlooks, I think the big story has been a return to the left-leaning governments who have, campaigned on a transformative reform agenda, only to be moderated by the political realities having to move much more to the center. Brazil, I think, has been an exception to that. The market was expecting the return of President Lula to be more matched by his first two terms, where he was reform-minded, but also very orthodox. I think the market has been somewhat surprised by Lula's propensity to spend, but we think the fiscal risks really are contained for this year. The new fiscal rule, which is being submitted to Congress at this moment and being reviewed, we think puts a lot of that downside fiscal risk on the back burner, where implementation of the rule will be the key risk looking forward. And then in Mexico, we think that despite the U.S. recession, we see positive momentum for the story of Mexico on nearshoring and friendshoring that will support the macro story. In CEMEA, we're watching Hungary and Poland, which we think will be supported by EU capital flows. We expect authorities to implement additional reforms, which are needed to unlock the balance of EU funds for the remainder of 2023. And then in South Africa, we're continuing to watch the record electricity blackouts, which have been weighing on the economic growth prospects for the country, as well as watching the declining terms of trade for the country, which has been weakening its current account balances. And in Asia, a lot of the stories being driven by the China reopening story, and through the tourism channel of as Chinese tourists finally get out of the country. So we think on the tourism side, this is largely going to benefit Thailand, Philippines, Indonesia, and Malaysia as the largest beneficiaries of the China reopening story on the tourism side. Just in the interest of time, I'm going to skip to the fund review on the Global Bond Fund and the Emerging Market Local Currency Fund. This is a review of the Global Bond Fund performance. Again, last year was a really tough year. This is a trailing one-year performance ending March 31st. We can see that the Global Bond Fund on the iShare returned negative 8.6%, but outperforming the FTSE WIPY, the benchmark, by nearly 100 basis points. The outperformance has been driven by the fund's shorter duration when we saw the yield back up. Again, really tough year last year. We see improvement and are pretty positive the asset class. Year to date, the fund is up 2.7%. We expect to see again dollar depreciation over the medium term and yield to be contained with a possible duration rally if growth begins to really slow. Here's a look at the portfolio summary. We can see the fund has a shorter duration relative to the index, similar in quality relative to the index in terms of its allocation to investment grade securities. And we are slightly underweight the dollar after you look, start adding U.S. cash to that position. Here's a look at the regional breakdown. We're slightly overweight Americas. This is a position in bonos or Mexican government bonds. We're overweight in Europe. We're underweight in Europe, but overweight in SEMEA. So we see, the SEMEA region as a beneficiary of core Europe stabilizing. And then we're overweight to developing Asia. This is mostly in Aussie dollar, New Zealand dollar, and a slight overweight to Japan government bonds. Here's a look at EM local currency fund. The iShare on a one-year trailing basis in the 131 is down 1.92%. This has underperformed its index, the GBI EM Global Diversified. The underperformance was really driven by, or the negative performance, the index has been driven by the depreciation in FX over the period, coupled with a sharp rise in global yields. Year to date, the fund is up 5.13%, so just a little bit short of the index, as we've been a little bit more conservatively positioned coming into the year. Here we can see the duration slightly shorter in DB-ELX versus Global Diversified GBI-EM. Slightly higher in quality in terms of its investment grade holdings. And on the currency breakdown, we can see it's the largest positions in the local currency funds, the next peso, South African rand, Indonesian rupiah, and Malaysian ringgit, followed by the Brazilian real. And with that, I'm going to turn it over to Su Fei to go over the emerging markets review.
Thank you, Val. For my segment, I would like to discuss how EM corporates and banks stay resilient while confronting the challenges and headwinds that Val discussed. I'll be going over the following: EM corporate fundamentals, default outlook, EM technicals, valuations, why we should be buying emerging markets debt, and is it time to buy EM? On EM banks, I'll be going over the financial stability of the EM banking system, why EM banks are different from Silicon Valley Bank, why we are comfortable with AT1 instruments. Lastly, I will go over the performance of the DoubleLine Emerging Markets Fixed Income Fund, DBLEX, and DoubleLine Low Duration Emerging Markets Fixed Income Fund, DBLLX. With the global headwinds and the challenges confronting certain EM countries as the backdrop, let me walk you through the current state of EM corporate fundamentals. On this slide, we can see that EM corporates continue to show strong net leverage ratios, EM high grade, the blue bars, and EM high yield, the gray bars, remained at some of the best levels seen in the decade at 0.9 times for high grade issuers and 1.8 times for high yield issuers. Similar to the net leverage, interest coverage levels for both high grade, again in blue, and high yield in gray, EM corporates remained at some of the highest levels seen in the years at 13.8 times for high grade issuers and 6.3 times for high yield issuers. I would point out that both credit metrics, that is, the net leverage and interest coverage ratios, are even stronger now than pre-COVID in 2019. We are mindful that some deterioration in EM companies' fundamentals will likely happen again in 2023, given the higher global borrowing rates and rising operating costs. The softening in commodity prices would suggest some moderation in cash flow generation for commodity producers. Our next two charts compare EM corporates' net leverage and interest coverage ratios with U.S. and European corporates. We see once again that net leverage figures in this slide for EM companies are better than their peers in the U.S. and Europe in both the IG and high yield space. Emerging markets' interest coverage ratios have typically been in the middle of the pack. That is stronger than its U.S. counterparts, but weaker than European companies in both the high grade and high yield space. Here, it is interesting to see in the chart on the right the divergence in the trend of the EM high yield versus its developed markets counterparts. Interest coverage for both the U.S. and European high yield credits continue to rise, whereas in the high yield for EM, it trended down starting in 2021. I would say this is partly due to the early tightening cycle that EM countries undertook, which led to higher borrowing costs for companies. On this slide, we see the default rates for the EM high yield in the solid blue line and U.S. high yield, the black line. They tend to move in tandem with each other. However, there was a huge divergence in 2021 with a high level of Chinese property sector defaults, and in 2022 with Russia and Ukraine credits defaults. This chart shows a direct impact of two headwinds faced by our markets in recent years: the collapse of the Chinese real estate sector and the Russia-Ukraine war. Now, I would like to draw your attention to the dotted blue line, which is the EM default rate, excluding the idiosyncratic defaults that I just mentioned, that is Russia, Ukraine, and the Chinese property credits. We see that the dotted blue line continued to move roughly in tandem with the U.S. high yield default rates. As a reminder, we do not have any Chinese property, Russian, or Ukraine exposure in DBLEX or DBLLX. Looking forward, the slide shows that we are expecting global EM default rates to moderate to 5.5% in 2023, against last year's 14%. The significant drop in the default rates is driven primarily by Asia and emerging Europe, as most of the de facto defaults have already happened last year. We are seeing a steady rise in LATAM defaults since 2021 at 2.5%, and is expected to rise to 5% for this year. It is worth mentioning that there have been at least 5 defaults in the region year to date. The bottom table shows EM default rates without the idiosyncratic defaults. We see the gradual rise in the default rates of the broader EM credits, starting at 1.2% in 2021, 1.8% in 2022, and rising towards a projected 2.1% for this year, likely on the back of slowing economic growth and rising funding costs. As we saw in the previous slide, the moderate increase in EM default rates is expected to be in tandem with that of the U.S. high yield credits, which is projected to be at 3% for 2023. Thirdly, the prospect of a slower global growth, a possible U.S. recession, higher borrowing rates, and tighter credit conditions, amongst other concerns, could lead to an even higher default rate. However, an implied default rate using weaker credits or distressed bonds trading at credit spreads above 1,000 bips could provide some insight and scope under a worst-case scenario. I would emphasize that this is a pessimistic scenario, as it assumes approximately half of the distressed bonds would default. Under this assumption, the default rate could go as high as 9.3% for this year, or over 9.3% versus a 5.5% forecast for this year. Still lower than last year, but similar to the 10% default rate recorded during the global financial crisis. Again, this is not our base case. We expect technical support for our asset class to remain in place given the projected modest pickup in new issuance volume for this year. The next two slides show the expected new issue supply for both sovereign and corporate credits. We are expecting sovereign new issues to pick up modestly to over 110 billion for this year, around a 16% increase from last year. Taken together with tender offers, buybacks, calls, and bond repayments and maturity, net financing for this year is expected to be almost neutral. So far, year to date, we have seen a flurry of sovereign new issue, totaling over 70 billion, already 60% of the year's projected new issues. They have been primarily from investment-grade issuers, but lately we have seen a number of high-yield sovereign issuers. In general, the new issues have been well oversubscribed and have traded well. Here we have the EM corporate issuance. The expectation is for a little over 300 billion in EM corporate supply this year versus 220 billion last year. Over the past 5 years, the average new issue supply had been around 400 billion plus per year versus the 300 billion we are expecting for this year. This is leading to 2 consecutive years of negative net financing. Again, negative 70 billion net financing for this year as a result of tender offers, buybacks, calls, and bond repayments and maturity. In general, much of the lower issuance had to do with market volatility versus credit fundamentals. With the 10-year U.S. Treasury yields rising over 100 bips from a year ago, which was at 2.33% at March 31, 22, and widening EM spreads, many companies have decided to, 1, either wait for lower volatility, 2, better rates which never came, or in the case of some of the weaker names, the companies could not access the market. Year to date, we have had around 86 billion in new corporate issuance, largely from IG issuers, representing 80% of the new issue supply. We were seeing good inflows into the asset class in the first month of the year in January. However, amid the U.S. volatility in February, coupled with the banking crisis in the U.S. and Europe in March, there was a reversal of flows out of the asset class. That said, year to date, the flows are still positive at 2.1 billion. Happy to report that last week we finally saw a break in the fund's outflows and had inflows into the EM fixed income funds. While the primary market has picked up recently, it is still driven by investment-grade issuers. Looking at the EM maturity wall, by and large, the majority of the corporate debt coming due in the coming 5 years is investment-grade, represented by the blue bars, while high-yield maturities in a gray, ranging from 71 billion to 104 billion through 2027, or averaging around 30% of the total maturities per year. EM corporates have been good about terming out their bonds early. As we look forward, roughly 60% of the maturities in the coming years are from IG Asia and Middle East issuers, which we expect should continue to have access to the capital markets or find support within their domestic markets. We are often asked by investors, why and when should I invest in emerging markets debt? Well, let me walk you through a number of slides to try to answer this and to illustrate why we remain constructive with the asset class despite the numerous headwinds. Here is a familiar chart which shows the cumulative returns of the EM Sovereign Index since its inception in 1995 through March 31, 23. The dark blue line represents the EM Sovereign Index against the light blue line representing the EM equity index as measured by the MSCI EM over the same period. There are two main points that I want to leave with you regarding this graph. First, we can clearly see that the EM sovereign index has had superior returns over EM equities. EM sovereigns have delivered an average annualized return of 8.5% since inception, spanning over 27 years. Second, EM sovereigns exhibited half the volatility as that of EM equities, as denoted by the standard deviation of 11.4% versus 22%. Taken together, we believe emerging markets debt has and should continue to deliver attractive returns. One positive side effect of the rate hikes has been a more attractive all-in yields. As you can see from this chart, at 8.5%, the yield of the EM sovereign index is nearly at a 13th-year high, which we believe is attractive for an index comprising of 52% investment grade, 48% high yield. And the EM corporate index, which is not shown on this slide, rated IG, is yielding 7%, over 7% for a 4-year plus duration. Coming off last year's challenges and into last month's banking turmoil in the US and Europe, we saw a whipsawing of the bond spread to the current range of 480 to 500 bips for the JP Morgan MBA Global Diversified Index. And the SAMB Broad Diversified in the range of 320 to 340 bips. The MBIG spread level is presently wider relative to its roughly 12-year averages and appear attractive. On the other hand, the spreads on the SAMB Broad Diversified at 329 bips is right there close to its historical average. We are mindful of the potential headwinds that we have talked about, that is slower global growth, predictions of possible US recession, tightening credit conditions, persistent high inflation, higher interest rates, volatile markets, among the many risks and challenges confronting our market. Nevertheless, we remain constructive on the asset class, but prefer to maintain a higher portion of the funds invested in higher quality names. The chart appears a little busy, but what I would like to draw your attention to is the following. First of all, in the history of the asset class, 2021 to 2022 was the first time we had back-to-back negative returns, negative 1.8% in 2021 and negative 17.8% in 2022. And indeed, last year, we had the worst performance in the history of the MB index. Secondly, the negative returns over the past 2 years were largely driven by the sharp move in U.S. Treasury rates as seen in the blue bars. Year to date, the MBIG index is up over 1.5% as of 4/24/23. Similar to the performance of the MBIG, the negative performance of the SAMB Broad Diversified in 2022 was predominantly driven by the U.S. Treasury repricing and to a lesser extent, credit spread widening, leading to reported negative 12.3% for 2022. EM corporates did better than EM sovereigns last year. And we continue to see a stronger performance from EM corporates versus EM sovereigns, with EM corporates posting nearly a 3% return year to date. Now, back to the question of what's a good time to get into emerging markets debt. To answer this, we ran some high-level scenarios using the MBIG historical data over a 20-year period from January 2003 to March 2023 to see what kind of returns an investor would get by buying EM bonds at various credit spreads over a 1-year holding period. This exercise confirms our views that our index begins to look cheap with spreads in the upper 400s to low 500s. We see in the table that if one were to buy emerging markets debt at credit spreads around 500 bips or higher, the average one-year forward return would be around 12%, whereas the worst drawdown would be a negative 8.8%. We note that probability of being down historically from these spread levels has been 2.7%. We're currently at 490 bips credit spread, so current spreads appear to be offering value. I'd like to summarize our presentation by breaking down our comments into three buckets: EM fundamentals, technicals, and valuations. Starting with the fundamentals, the positives we see are EM remains a secular improving credit story. We believe the asset class is likely to continue to migrate up the credit quality curve. EM central banks started tightening their policy rates earlier than developed market central banks, and we are seeing some of them starting to pause, and indeed some countries could potentially pivot later this year or early next year. In fact, we saw Uruguay, the first LATAM country to cut rates last week. China reopening could provide a lift, broader EM growth, and also provide support to commodity prices. We have healthy EM banking system, which I will be going over in more detail shortly. Higher GDP growth for emerging markets versus developed markets. We saw continued strong corporate credit metrics, although we do expect some weakening this year. Although again, like last year, from a strong base, we expect EM default rates to moderate. Now on the negatives and risks that could affect EM fundamentals: elevated geopolitical tensions, slowing global growth, potentially a U.S. recession, noise around U.S. debt ceiling, global financial instability, persistent high inflation might necessitate some central banks to continue to high or maintain higher rates for longer. And lastly, there are idiosyncratic country risks. Moving on to the positive technicals in the middle column, we are seeing supportive technicals both in terms of new issues and funds flow. Both sovereigns and corporates' primary supply expected to moderate this year. Indeed, we are still expecting negative net financing for EM corporates. EM high-yield debt maturities do not appear to be onerous in the coming years. Year-to-date, fund flows are still positive. Furthermore, JP Morgan is forecasting funds flow to remain positive for their asset class for 2023. Negatives is that we have recently been experiencing outflows, but they appear to be moderating. On valuations, positives are the asset class has delivered solid historical performance. We believe it's an asset class that can continue to deliver mid to high single-digit annual returns. Valuations are presently attractive given the wide MB spreads, along with an attractive 8.5% all-in yield. Within EM corporate index, the high-yield subsector offers value over U.S. high yield with a generous pickup of over 200 bips over U.S. high yield. Negatives, looking at the EM corporate investment grade subsector, it is trading tied to U.S. investment grade credits with current pickup of only around 25 bips. Certainly, spread widening in the U.S. high yield market will have negative knockdown effect on our markets. So in summary, we believe the asset class continued to be resilient, and we are also looking at we believe the asset class continues to be resilient, and we remain constructive. While we acknowledge the many risks still present, we believe there are pockets of opportunities, and bottom-up credit selection is critical. We currently prefer to maintain a higher portion of the funds invested in higher quality names, and we are also looking at opportunities in the primary market for new issues that come with pricing concessions. Concerns and questions surrounding the financial state of EM banks have been on the top of investors' minds stemming from the recent banking turmoil in the U.S. and in Europe. Val discussed what we could see as some of the potential macro implications from the Silicon Valley Bank fallout. Certainly, they may also have negative ramifications for EM banking sector and to the broader EM market. Overall, we believe EM banks have strong balance sheets. EM banks operate in a well-regulated environment in their respective countries. Most EM banks have implemented Basel III, which raised the bank's overall capital level requirements. They have healthy asset quality along with solid capital ratios. EM banks tend to maintain a diversified base of depositors, helping to insulate the banks from the type of bank runs that we saw at SVB and other regional banks. In general, EM banks are profitable. Nevertheless, we're cognizant of potential headwinds ahead. Slower economic growth could lead to weaker loan growth for the banks. We're also expecting a moderate decline in asset quality, an uptick in non-performing loans, and weaker net interest margins. But EM banks are starting from a solid base. EM banks made up about 1/3 of the EM corporate index, and they are also well represented in our funds. As of 3/31/23, the bank exposure in DBLEX stood at 18.5% and 24% in DBLLX. In this respect, we also tend to focus our banking exposure on the largest strategically important banks in their respective countries. For the bank slides, we have selected a sample of EM banks that we currently have the largest exposure to in each of the countries. Banco do Brasil in blue is the third largest bank in Brazil, and it is majority owned by the Brazilian government. Banorte, the red bars, is the second largest bank in Mexico. Interbank in purple is the fourth largest bank in Peru. The bank has strong focus on retail loans. Hapoalim in gray is one of the two dominant banks in Israel. And lastly, in yellow, OCBC is the second largest bank in Singapore. It is one of the largest lenders in Southeast Asia. The two graphs here show that these EM banks have healthy asset quality metrics. The graph on the left show the NPL ratio. Most of the banks are showing historically low levels of delinquency, with NPL levels below 2019. As we mentioned, we expect a modest increase in NPLs across the board during 2023, and we're starting to see that in Brazil. But overall, we are starting from low levels of delinquency. And the banks have good coverage ratios. The graph on the right shows the coverage to NPLs. All of the banks above 100%, and for most of the cases, flat to higher coverage when compared to pre-COVID levels. The graph shows the bank's customer deposits in US dollars. Overall, we see stable to higher levels of deposits when compared to 2019. It is important to note that this was achieved despite some FX headwinds when expressed in US dollars, which is the reason behind some of the year-over-year variability and declines in some years. Let's focus on Bambra Brazil, the blue bars. The BRL depreciated 23% in 2020 and 7% in 2021, and overall 24% during the period was showing. In local currency, deposits have been trending up consistently. The graph on the left shows net income in US dollar. Net income has recovered from the low levels it had reached at the beginning of the pandemic in 2020. And for most of the banks, it is now above the pre-COVID levels of 2019. Among the main drivers of the improvement during 21 and 22 are low provisions for loan losses on the back of strong economic activity during 2021 and 2022, a pickup in loan growth, net interest margin expansion as the large banks benefit from the higher interest rate environment. The graph on the right shows the Tier 1 capital ratio of the banks. All of them show strong levels of capital with healthy cushions over the minimum required by each regulator. The requirements ranges from about 8 to 9.5%. In the case of most of the LatAm banks, they now hold higher levels of capital than what they had pre-COVID. I would like to briefly give a little background of what happened at Silicon Valley Bank and why we believe EM banks are different from SVB. SVB had an asset composition that is not very typical for a bank, not in EM nor in the U.S. As you can see on the slide, most of its assets were securities as opposed to loans. While securities do have a role in a bank, mainly to manage its liquidity, it is not typical to see it as a large source of income and assets. As of December 22, SVB had 57% of its assets in securities, while loans represented only 35% of the total assets. While the securities they held were high quality, very liquid instruments, they were not short-term, therefore exposing the bank to interest rate risk. In an effort to boost its earnings, the bank had reached for extra yield over the last few years and bought the long end of the curve. But as interest rates started to rise in 2022, the valuations of those securities declined, and such loss of value was not floating to the P&L or to the equity of the bank because they were classified as held to maturity. The graph on the right shows that over 40% of the securities portfolio was not marked to market. This situation remained under the radar for a while some depositors started to catch up to this and decided to withdraw its money. Specifically, on March 8, 2023, the bank provided a mid-quarter update announcement that flagged a $1.8 billion loss from the sales of securities. So with that, why do we believe this is not a concern for our holdings in EM banks? Well, one, EM bank security holdings are a relatively low percentage of total assets. The loan portfolio is generally their main asset. Two, most of the securities are marked to market. Only about 5% on average is in the held to maturity bucket that is not marked to market. And lastly, while we have not seen a big shift in deposits in EM, but if we were to see one, we believe since the banks we hold tend to be among the largest in each country, we believe they would benefit from any flight to quality in their respective markets, similar to what happened in the U.S. with the large money centers. Now, let's talk about another topic that has been on investors' mind about the banks, the write-downs of AT1 bonds of Credit Suisse. AT1 instruments, also known as contingent convertibles or COCO bonds, can be converted into equity if a bank's capital ratio falls below a predetermined level. Regulators can write it down as well if a bank starts to fail. There's been a lot of discussion about the fact that equity holders were allowed to reserve a small value, $3 billion, of its investment after the merger with UBS, while bondholders of the AT1s were wiped out. While this is interesting discussion about the features of the instrument and the regulations around it, I like to focus on our portfolio and why we're comfortable with our exposure on AT1s. Before I move on, I would say that our exposure to AT1s is small, 3.9% in DBLEX and 0.82% in DBLLX as of 3/31/23. In DBLEX, the AT1's exposure are with three banks, Banco do Brasil. Again, as a reminder, it is the third largest bank in Brazil and majority owned by the Brazilian government. Banorte is the second largest bank in Mexico, and Davivienda is the second largest lender in Colombia. In DBLLX, we hold 0.82% of the Banorte AT1s as of 3/31/23. Before then, the SVB news, it was a known fact that CS had been experiencing problems over the last few years. So why do we feel comfortable with the AT1s of the EM banks we hold? This is because we are focused on high-quality EM banks with stable results and solid funding profiles. In addition to what I've already mentioned about the solid balance sheets of these EM banks relating to the asset quality and capitalization, I want to focus on two key differences from the CS case. The graph to the left shows the deposits measured in U.S. dollars have been steadily rising for the EM banks where we have exposure to the AT1's instruments. This is despite some FX headwinds. If measured in local currency, the trend for deposit would even be stronger. the banks have shown consistent profitability. 2021 was a weak year for most of them, but even then, net income remained in positive territory. And over the last year, profits are at a healthy level. So again, we are comfortable with the AT1 exposure in the funds as they are with blue chip banks with solid asset quality and capital ratios, and they are profitable institutions. At the same time, our AT1 holdings in DBLEX and DBLLX are small. We now turn to the review of the performance of DoubleLine Emerging Markets Fixed Income Fund, DBLEX, and DoubleLine Low Duration Emerging Markets Fixed Income Fund, DBLLX. So 2022 was a challenging and difficult year for most asset classes, a year most investors are glad is behind them. It was no different that our funds would suffer negative returns last year. Despite finishing the difficult year with a negative return of 14.5%, it was good relative to the benchmark, which is the JP Morgan MBIG, that had a negative return of 17.78%. One of the primary drivers for the fund's outperformance for 2022 was a zero exposure to Russia and Ukraine in DBLEX prior to Russia's invasion of Ukraine last February. Indeed, we had no exposure to either country in both DBLEX and DBLLX since around the time when Russia took over Crimea in 2014. Russia's invasion of Ukraine subsequently led to the removal of Russian exposure from the index on 3/30/2022, which meant a complete write-off of a 3.3% Russia weighting in the index. As I've talked about, the large negative returns in 2022 for both DBLEX and its benchmark were largely driven by the U.S. Treasury repricing. Now let's turn to DBLEX performance on this slide. At the top, we see the fund's performance over the last 12 months ending March 31, 23. The iShares returned a negative 8.33% versus the fund's benchmark, which had a negative 6.92% return over the same period. The fund underperformed by 141 bips relative to benchmark. Again, much of the negative performance was driven by the dramatic U.S. Treasury movement, coupled with wider credit spreads, had negative impacts on the fund's performance over this period. The fund's underperformance relative to its benchmarks was due to the fund's overweight to Latin America, the weakest performing region during the year, as well as the fund's underweight to the emerging Europe and Middle East region, which had the least negative returns of the different regions. The bottom chart shows the fund's performance during the first quarter of this year, posting a positive return of 1.59%, but slightly underperforming the benchmark return of 1.86%. The fund's underperformance was hurt by its shorter duration relative to the benchmark. This slide shows the fund and the benchmark's performance, standard deviation of Sharpe ratio since inception and over the past year. Since inception, the fund's iShare has shown a Sharpe ratio of 0.39, right on top of its benchmark, below that of the corporate index, SEMBI, and well above the local currency index, GBI-EM Global Diversified. I'll just go quickly over the next couple of slides in the interest of time. This slide shows the fund's performance over different time periods versus benchmark and peers, showing that it has been on the top quartile the past 5 years and the top 11% over the 10 years and top 4% since inception. This is the fund's Sharpe ratio over different time periods versus its benchmark and peers. DBLEX has been in the top quartile on a risk-adjusted basis over the past 5 years and the top 11% over the 10 years and top 4% since inception. This is a snapshot of the fund's composition as of 3/31/23. We continue to overweight the investment-grade subsector of our market. The fund is underweight to the single B relative to its benchmark. By and large, while there remains numerous headwinds, as we have discussed, we would expect weaker credits, such as the single Bs and below, would tend to underperform, we have noticed that historically it is the upper end of the credit spectrum when the bond spreads begin to tighten first when the markets recovered. At the margin, we have started to add to some high-quality BB credits. We continue to favor Latin America with a 33% weighting in the portfolio as of 3/31/23, rounding out Colombia, Mexico, and Chile as the top 3 country exposure. This is largely because we continue to see LATAM credits offering the highest relative value. Asia has the second highest allocation at 26%. The fund's duration was slightly shorter than the benchmark at 6.26 years at the end of March, and the fund remained 100% US dollar denominated. EM corporates make up roughly 58% of the fund, followed by nearly 23% sovereign and 16% quasi-sovereign issuers, with 2.6% cash at 3/31/23. A few things we have been doing. One, we have been reducing some of the longer dated sovereign bonds and targeting specific high quality corporate credits that we like, credits with dislocated prices. In addition, we've also been gradually reducing the fund's duration, primarily by selling the longer dated sovereigns and buying those credits that are callable in the next 3 to 5 years, with issuers that we've known to have a track record of calling their bonds. In terms of sectors, besides reducing the sovereign exposure, lower positioning has changed among the other industries. We continue to gravitate towards these sectors that are strategic to an economy, which we define as utility, banking, natural resources, that is oil and gas and mining, and we also like the telecom. These sectors are well represented within our funds at over 55% of fund holdings as of 3/31/23. Now moving on to the EM low duration fund, DBLLX. Again, like many asset classes last year, DBLX was down, but the fund outperformed its benchmark by several hundred basis points in 2022. Similar to DBLEX, DBLLX did not have any exposure to Russia or Ukraine in the fund. Over the past rolling 12 months ending 3/31/23, DBLLX iShares returned a negative 0.8%, which underperformed versus the fund's benchmark, which is the JP Morgan SMB Broad Diversified 1 to 3 year, which had a positive 2.55% return over the same period. Similar to DBLEX, the underperformance was largely due to overweight to LATAM credits, which was the worst performing region over that period. For the first quarter 2023, DBLEX posted a positive return of 1.15%. However, underperformed the benchmark's return of 2.08%. The primary driver of the underperformance of the fund was regional allocation. The fund maintained a large overweight to LATAM relative to the benchmark, which provided the least positive return within the broader index. In contrast, its longer duration contributed to relative performance. This slide shows the fund and benchmark performance, standard deviation, and Sharpe ratio since inception over the past year. And since inception, the fund's iShares has shown Sharpe ratio of 0.29, slightly lower than the 0.37 for its benchmark. Now, I'm just going to skip over the next couple of slides. We will get to the breakdown of the fund composition. So on this slide, we have the breakdown of the fund by country and the portfolio statistics for DBLLX as of 3/31. We continue to overweight the investment grade subsector of markets with nearly 74% allocated to IG. We reduced the sovereign exposure, which stood around 15% a year ago, to 6.3% at 3/31/23. We continue to favor Latin America with a 48% weighting in the portfolio, while Asia has the second highest allocation at 39%. The fund's duration was 2.6 years, higher than the benchmark at 1.7 years. And the fund duration, and lastly, the fund remains 100% U.S. dollar denominated. And similar to DBLEX, the sector positioning is consistent to DBLEX. Again, we gravitated to its strategic sectors of the economy, that is banking, utilities, oil and gas, telecom, and mining, which made up over 70% of the fund. And with that, we have come to the end of the presentation. I believe we are way over the hour, and I'm looking at some of the questions. I believe we have answered most of the questions in our presentation. So we're going to end the webcast. I'd like to thank everyone for joining us today, and we look forward to seeing you again in our next webcast. Thank you.